I'm about to show you exactly how I'm able to make 100K every single month off trading, and all you're gonna have to do is copy me step by step and you'll be having the same results in no time. So let's get into it. Hanko Trade just dropped a brand new platform called Hanko X. Not only is the new platform easy to use and it looks amazing, but they're adding new features all the time. They just added the ability to be able to drag your stop loss and TP anywhere you want so you can see it on your charts. And they also have copy trading, so you can go on there, find you a profitable trader and copy all of their trades instantly. Most of you guys know I've been with Hanko Trade since the beginning of my career, and they're really the only broker that I trust at the moment. So if you guys want to trade with the same broker that I trust, the link is in the description. Sign up now and let's get to making some money. First things first is we got to get your charts looking right. Now if you're brand new to trading, you're going to want to go to tradingview.com, sign up for an account. It's free. You're going to need this to start trading. So when you're on TradingView, you want to erase every indicator that's on there when you barely open up your chart. We do not need indicators except for one, and I'm gonna tell you exactly what that is in a second. But before we get into that, let's go over my settings and the tools that I use. So these are my settings right here. If you want to copy my color scheme, you can. We just got the red, 100% opacity. There it is right there. I'm just gonna click through all these. You can look through them. So now that we got your colors on point, right, we want to go to the tools. Now the tools is we're going to be using them all the time, right? These are my tools right here. Now to get the tools, you're going to want to go to the left hand side. You're going to see when I go over this cross right here, there's a little arrow on the side, right? You're going to click on that. It's going to show you all the variants for this option, right? So we got the cross, we got the dot, the arrow, and the eraser. Now you want to have the cross. So if you look at my cross on screen, you see I have these extended lines out. That's what the cross is for. So you can like use it to see levels in the market. It just really helps out. So when you want to favorite something and you want to put it in a tool like this where it's easy to use, you want to hit the star next to it, right? So if I hit this star, you see the dot popped up right there. So that's how you save it as your favorite, and it's going to be in this little tool chest up here. Now let's go down one, and we got the trend line, right? We're always going to be using trend lines. It's very great to have, so star that. We're going to star the horizontal line, right? A horizontal line does what it says. It's just a line in the middle of your chart. You can move it around for levels, support and resistance, bouncing off of here, right? Don't worry, we'll get all into the support and resistance a little bit later. Now let's go to the next thing. We have a horizontal ray. It's the same thing as a horizontal line. It just doesn't go both ways. It only goes one way, to the right. Now I think that's all I have for this section. Yes, it is. So let's go down to the next one. The Fibonacci retracement. Now I don't use this, so I'm actually going to unstar that. All right, I don't use anything from this. I don't use anything from that. Now right here, these are very important. You do not want to leave this out. The long position, short position. Now this is how we take our trades, right? This is how we calculate our risk to reward. This is everything right here. So the long position is this tool right here. The green is when you're in profit. The red is when the trade is going against you and it's heading towards your stop loss, which is right here. This is your stop loss. This is your take profit. Now when you use the long position tool, that means you're looking to enter a buy, right? Long means buy, short means sell. So if I'm taking a long position, that means I'm looking for a buy. So if we entered right here, we're saying, hey, I think it's going to go up, which it did. We'll put our stop loss down here. So if it comes down here, we don't want to be in the trade no more. So that is a long position. Now with a short position is the same thing, just for sales. So let's say we want to enter right here and we say, okay, I think it's going to go down. So this is a short position. We get our short position tool. We set it up how we want. We put our stop loss. So if the trade comes up to here, our trade gets cut, it hits our stop loss, and we do not want to risk any more money on this trade because we were wrong. But if we're right, it'll go toward the green side and we'll be in profit making that money. So you definitely want to have that tool on there because we're going to use them for every single trade. Go to the next one. Now we got a highlighter, we got an arrow, rectangle. Now rectangles are very important. You definitely want to have that. Rectangles to drop supply and demand, support and resistance. Let me just show you. So it's just a rectangle, right? But we use these kind of like a horizontal line, but with trading, it's never precise areas. You want to have a more of a zone than just a line like this, right? Because this is too precise. You know, trading is kind of ugly. You want to have a zone that you want to be ready to use. So instead of that line, you would put this zone right here. Now a path is good for teaching and just hypothesizing stuff. So it's just like, you know, you can draw up trends, however you think the market is going to go, you know, whatever you want to do. I think the market's going to drop and then come back and then drop. So that's what a path is. It's good for marking out things that you think is going to happen. Now the text is great to have because you want to be able to write. So you would just write something right here like BOS, which means break of structure. So let's say we had a break of structure right here. We would put our arrow, put text, BOS. So we know that we had a break of structure. So we just keep that in our mind, right? So actually the break of structure would be right here just to be accurate. So that's very important. And I think that's pretty much everything I have. You know, you got your emojis. Maybe you win a trade, maybe you want to put a thumbs up when you win. Maybe when you lose, you want to put a thumbs down. So just go through all these tools right here. That's pretty much everything I have. And of course, you have this trash can to delete everything, or you could just remove the indicators or the drawings. I'm gonna remove the drawings. Now let's get to the only indicator that I use. What you're gonna want to do is go up to indicators right here, and you're gonna type in Kill Zones by Oscar VS, right? This is the one you want, by Oscar VS. You're gonna click that. All these colors are gonna pop up, and you're gonna be like, what is going on, right? Now what the kill zone indicator does, it shows you the different sessions in the market. Right now we got 3 different sessions. We got New York session, London session, and Asian session. Me personally, I trade the New York session because it has the most momentum, and you're gonna get the biggest trades there. So what we would do is go to kill zones. You're gonna go to settings right here. You can go to inputs. You're gonna turn all these off besides New York kill zone. Now if you want to trade London session, you would leave these on, turn off all these. So you push OK. Now we have the New York kill zone, right? So we're only going to trade in these zones. So as soon as this white line pops up and we're in this gray zone, we're ready to trade, right? This is the best time to trade. You're going to get those nice movements. If you see right here, look all this movement that happened inside this gray zone when it was just being ugly, consolidating, not really making a move, not knowing what direction it wants to go to. But as soon as it enters that kill zone, we blast off, right? So it's very important to have this indicator on. Now me personally, I take this white line off because I feel like it's extra, so that's what I'm going to do right now. Now it looks nice and clean and good, right? We don't need all these indicators. They don't work anyways. So now that we got your charts looking good, we need to get into market structure and how to read the candles, because these candles are telling you a story, and if you're able to read it, you're going to make a whole lot of money. So let's do it. Now the first thing you need to understand about market structure is that price only likes to move in 3 ways. It's either in an uptrend, a downtrend, or it's consolidating sideways. So let's look at an example. So if you just zoom out of your chart, you'll see exactly what I'm talking about. So let's get our path. You can see right here we had this big push in New York session, right? We had an uptrend. Now we go sideways. Now we have consolidation, right? Consolidation is when it's not moving up or down. It's just kind of staying and kind of zigzagging in the middle, right? Consolidation. It's not sure which direction it wants to go yet. But after consolidation, now we have a downtrend. And this is how the market moves all the time. So you always want to just zoom out and take a look to see what phase are you in. Are we uptrending right now? Are we consolidating, or are we in a downtrend right now? We should be looking for sales, right? Because you always want to trade with the trend unless you're a counter trend trader, which is way more advanced. If you're just getting started or you haven't been profitable yet, trust me, trade with the trend. The trend is your friend. So now that we understand the phases of the market, now let's get into the actual market structure itself. So the market likes to move in higher highs, higher lows, or lower lows and lower highs. Now let me show you exactly what that looks like. So we get a high, a low, a higher high, a higher low, a higher high, and a higher low. So a higher high is exactly what it sounds like. This high is now higher than this high. So now this is the new higher high. Same thing with the lows. This low is higher than this low. So now this is a higher low. Very simple, right? Now let's see a lower high and a lower low. So we got a low, a lower high, a low, a lower high. This low is lower than this low. So now this is the lower low. This lower high is lower than this lower high. So now this is the new lower high. And we can predict that price is going to now make a new lower low. So let's say we have a high, a low, a higher low, and a higher high. But then price comes, and instead of making a higher low, it actually comes and makes a lower low. Now what is this? This is what you call a break of structure, right? So while we were creating market structure, which is higher highs, higher lows, and following the pattern, all of a sudden we broke that pattern and made a new lower low instead of a higher low. So instead of making one of these where the higher low was above the last higher low, we actually came and broke through them, right? So once we came lower than this previous higher low, we officially broke structure, right? We broke the pattern. It's not supposed to happen. So this is an indication that price now wants to switch trends. So instead of it being bullish or a long position where we're making higher highs and higher lows, we now want to change to a bearish position where it's making lower lows and lower highs. So this is how you identify a breakup structure. Now we can abbreviate that with the BOS, breakup structure. And you always want to mark up your breakup structure. So once you see that we had a higher high and then it broke the previous higher low, we know we have a breakup structure. So we draw a line right there to indicate this was the breakup structure. Now the way to know if you have a valid breakup structure is price had to make a higher high before it broke the previous higher low, right? This low couldn't have been lower like this and then it happened. It has to have a higher high, and then when it breaks the previous lower low, then you know it's a breakup structure, because a higher low is only valid if a higher high is formed. Now this is very important. Do not skip this. You need to write this down. A higher low is only valid if a higher high is made. So let's say we made this higher low and then price came right here and didn't break this higher high to make a new higher high, right? Let's just say price did this. This wouldn't be a valid higher high because we didn't break the peak of this. So that means this higher low is not a higher low. It's not valid. It needs to come up and close above this peak right here, forming a higher high for this higher low to be valid. That is very important. So if this higher high is not here, this higher low is not valid. It's going to fake you out. This is very important. Rewatch this, write this down. A higher high needs to be formed for a higher low to be valid. Now, if that higher low is broken, we got the breaker structure. I know it's a little complicated, but once you get this down, you're going to be able to read the charts like nothing. So now that we went over market structure, let's talk about the candlesticks themselves, right? This is very important because every candlestick is telling you a story and you need to be able to read that story to make some money. So let's get into it. So first things first, this is a candlestick, right? Let's talk about this candle right here. Now you see this big old line coming out the top of this candle. This is what we call a wick, right? Just think of it as like a tail. When you see a big wick right here like that, that means price has just rejected this area right here. So that means buyers were in the market pushing this candle up, and then sellers took over and they were much stronger than the buyers. So they pushed it back, rejecting this zone. They basically said, nope, you're not coming to this zone. We're pushing back. So they pushed the buyers all the way back down. And when the candle closed, the sellers won the tug of war and it left this big old wick, right? Which we call a rejection. They basically rejected it, said, nope, you're not passing this zone right here. Not today, buddy. So that's what a wick is trying to tell you, right? They got rejected. The sellers are way too strong right here. Buyers couldn't win. So that's a wick. Now I want to show you this candle right here. So we have the wick up here, and now where the actual candle is, we call that the candle body. So now that we can see this candle is way bigger, closing above the wicks of the previous candle, we call this an engulfing candle. Now this is a sign that the momentum is there and the buyers are in position. Here's another engulfing candle right here. These are just very strong candles. So when you see an engulfing candle, you can bet that it's probably going to print a couple more candles going the same direction as that engulfing candle. So as you can see, this red bearish engulfing candle or this short candle is very strong. You see no wicks on it. It's engulfing all these previous candles right here. You can bet there's going to be some more red candles printed after that. So now we know what engulfing candle is. We know what a wick and a rejection is. And the name for a candle like this, where there's a small body and a huge wick coming off of it, is called a hammer candle. So if you can look at it, you can kind of see it looks like a hammer, right? An upside down hammer. These hammer candles usually indicate that a bullish engulfing is coming right after it. So if you have these two, it's a great indication that we're probably going to drop pretty hard right here. Here's another example right here for the buy side. So we have this hammer candle right here. It's the same thing as this one. This one is just upside down and this one is just up. So if it's upside down, that means we're looking for it to drop. If it's like this with the head of the hammer going up, that means we're looking for buys, and you can see what happens after it. We have these big push of momentums. So it's very important. Now I want to talk to you guys about this candle right here. This one looks like a hammer candle, but it's different. This is called a doji candle. The reason why this is not a hammer candle is because when it's a hammer candle, the body needs to close more toward one direction, right? So if this body was up here and then the wick was coming down, it would be a hammer. But since the body is in the middle with two wicks coming out both sides, that is what you call a doji. And a doji indicates that the market doesn't know which way it wants to go. It's undecided. So it could go either way, up or down. So that's what a doji is trying to tell you. The buyers and sellers are kind of even right now. They're kind of tug of warring and they're at the same spot. So that's what a doji indicates. And you'll usually see a reversal when there is a doji. It's not all the time, but it's more likely you will see a reversal after a doji, or at least some type of drop, right? So we've been going up, then we get that doji, we get this little drop right here. So those are the three candles that you really need to know. There's plenty of patterns and different type of candles that you can look into, but I've only ever used these three in trading in the last 4 years. So now that we got your chart looking right, we got your indicators up, you know how to read the market structure, you know how to read the candlesticks, let's get into the actual strategy that makes me over 100K a month. So you can do the same thing. Now this strategy is called supply and demand trading. Now there's multiple ways that you can trade supply and demand. So now let's get into one of the easiest and the best ways I found to trade it. So first things we got to talk about is what is even supply and demand? So the easiest way to understand supply and demand when it comes to trading is supply means short and demand means long. So with supplies, we're looking for sales. With demands, we're looking for buys. No need to complicate it. That's all it is. Now I'm going to show you how to locate supply and demand zones. So I'm going to show you a couple of examples of demand zones so we can go over that first. So this is a demand zone right here. We have 1, 2, 3 candles going the same direction and are the same color, and they are large candles showing momentum, right? Supply and demand is basically just momentum. So since this is a demand zone, we're going up. So we have 1, 2, 3. Usually it'll be 3 candles. It can also be one very, very large one, or it can be 2 candles. You just want to see the same color candles pushing up with momentum, with some strength, with some power with them. And that's how you locate a demand zone. It's really that simple. Same thing with supply zones. Take a look at these candles right here. We have one large supply candle dropping. Then we have another one. So this is called a supply zone because we dropped so aggressively with lots of momentum. That's letting us know all the sellers waited till this point to get in and push the market very strongly down. So this is a 2 candle supply zone right here. Let's go over a couple more examples. So I'm gonna give you a second. What is this? Is this a supply zone or a demand zone? This is a demand zone because we have large candles going up, right? That's what's very important. Demand is up. So we have 3 candles the same color. We have a 3 candle supply zone, which is great. Now look at this beautiful supply push right here. Now this is a great supply. Look at all these. This is a 5 candle supply zone right here. 1, 2, 3, 4, 5 strong momentum candles going all one direction. All the sellers waited to this point to all get in, right? Another thing you want to remember about supply and demand zone is when you see these big pushes right here, us retail traders can't force the charts to do this. This is big institutional banks entering the market, pushing it down. So these are whales that are entering the market and pushing in one direction. So we want to ride that wave, right? We want to trade with the banks. We want to trade with the big players. So that's why we locate supply and demand zones, because that tells us a whale or a bank just entered the market. So here's another demand zone right here. The demand zone starts from right here. We push up strong with momentum, all the same color, looks great. We got a demand zone. We also have another demand zone right here, right? We consolidated a little bit. The banks entered, pushed up the market all the way up here. So this is a great demand zone right here. Now I'm just start marking up different supply and demand zones. Demand zone, demand zone, supply zone. See right here, these are not considered supply zones because it's not strong momentum pushes like this one. Now this is a supply zone. This one isn't a supply zone, right? It doesn't have the same colors going down, doesn't have strong momentum candles, no banks entered right here. This is just normal price action. This is where a bank entered. This is a demand zone right here. This is not a demand zone. You see how we got little candles in there? This is not a demand zone. We need the big pushes, strong momentum candles forming. This is a supply zone right here. Demand zone, demand zone. So supply and demand is all over the chart. It's not hard to find. They're literally everywhere. That's how the market moves. Strong supply zone right here. Strong supply zone right here. So now that you know how to locate supply and demand, now we got to talk about the gaps in the market. Now the gaps in the market is very important, and this is what changed my life. I was trading for years and years with no success until I figured out the gaps in the market. So this is how you locate a gap in the market. So let's take these 3 candles right here, right? We have 1, 2, 3 candles right here. Now I want you to look at the wicks of the candles. This top wick on the first candle is not touching the third candle's bottom wick, and it's supposed to, right? It's kind of like the law of trading. There can't be any space in between these 2 candles. So when price is going up, the first candle, we want to look at the top wick, not the bottom wick. So we look at the top wick, and then we skip the middle candle, and we go to the third candle, and we're going to look at the bottom wick of the third candle. We're not looking at the top wick, we're looking at the bottom. So you can get a horizontal ray, put it at the top of the first candle wick, get another ray, and put it at the bottom of the third candle wick. Now you see this space in between these 2 lines? This is the gap in the market. This is supposed to be filled. These 2 are supposed to be touching. So if your lines are not overlapping and they have this space, this is a gap in the market. And one thing about gaps in the market is 100% of the time they need to be filled. Now in trading, there's very rarely anything that works 100% of the time. but gaps in the markets will be filled 100% of the time. And I'll prove it to you right now. So let's go to some random spot in the past. Just go randomly. I don't even care where it lands. We're just gonna go there. Okay, so let's mark up some gaps. So you see right here, let me zoom in. This candle right here is the middle candle. So whatever candle we think has the gap, you can just look at it and be like, this is a big candle, and I can tell that there's space on the left and right of it. Let's verify and see if there's a gap. So we're gonna go to the candle before the one that we think has the gap, and we see this wick. Now when price is going down, the first candle, we're gonna look at the bottom wick instead of the top one, right? When it's going up, we're gonna go to the first candle's top wick, but when price is moving down, we're gonna go to the bottom of the first wick. So we draw our line there. Then we're gonna go to the third candle, and since it's going down, now we're gonna use the top wick on the third candle instead of the bottom one we used for when price was going up. Put a line there, and you can see there's a space, and now there's a gap in the market, and it will always be filled. So let's say we got that one. Let's mark another one since we're here. We see this huge drop, and we're like, no way this can be filled, right? This is obviously a gap in the market. There's no wick right here touching this first wick, so we'll draw it there. Come get this one, go to the third candle, draw it right there at the top of that one. Right now this is a huge gap in the market, and I promise you it will be filled 100% of the time. Go to the right. Price comes, it gets filled. Comes, fills the second. Comes up more, fills the other gap. It will always come and fill the gap, and we can use that to our advantage. So now that I just proved that every gap gets filled, I want to show you an indicator that's going to find these gaps for you. So if you have trouble finding them on your own, you can just use this indicator. Go to indicator, you're going to type in fair value gaps, and you're going to want the one that's by Lux Algo. Put that on. Now once you put that on, you're going to see these boxes, right? The red ones are for the sales, the supply zones. The green ones are for the demand zones. And just by looking at this, right, you can tell how the gaps are in the market. So you want to look at the beginning of this box, right? We don't have to pay attention to this right now. Just look at the beginning of the box. Everything I told you. If we think this one has a gap, we're going to say, did the first candle bottom wick touch the top candle of the third candle? So you get our lines, we put them right there, and we put it at the top of this third candle, and we see the gap in the market. So this indicator just does that for you, where you don't even have to do it no more. Now let me show you what happens when you have a supply zone or a demand zone and a gap in the market. So we have our supply zone right here, two large candles letting us know that a bank or a well or a big player just entered the market. So now we have the supply zone. We got one checked off. Yes, we needed that. Now we ask ourselves, was there a gap in the market? Yes, there was. By using our indicator, we can see these red box, there's two gaps in the market. Now what happens when price came back and tapped this box right here to fill in the gap? Well, as soon as we came into the gap and we filled it, price dropped aggressively. So you could have put a short position right here. You could put it at the top of the box. There's different ways you can do it. I'm just using this as an example. I'm going to show you more advanced way right now. So as soon as it came, tapped this gap in the market, we dropped and we would have made money. So if we risked $1,000 right here, we would have made $5,000 when it came down here. But imagine you would have risked $10,000 or $20,000. Now you're making serious money in one trade. So now let's look at a gap on the demand side. You can see right here, this indicator marked up a gap, right? Price came down, tapped it, broke through it, and then shot up. But most of the time when these gaps get tapped, it's going to reject and go the way that you want it to go. These gaps are basically giving opportunity for other banks that missed out on this first push to get into the trade, and that's where they enter and you get a huge push. So now that we know all that, there's one more thing that's missing from the strategy. We need to have a breaker structure. Remember, we went over that a little while ago. We need to add that to our confluences. Our confluences are the reasons why we're going to take the trade. So we had our lower low right here. This little green candle came up, made a lower high, which wasn't valid until we made a lower low. So once this lower low was made, now this lower high is valid. So if this lower high right here gets broken, we have a breaker structure in the market, and that's exactly what we want to see to take a trade. So we get that breaker structure. Great, check that off. Is this a demand push? We need to ask ourselves. Yes, it is a demand push. We have strong candles, same color, pushing up all the way up to here, right? So we have a very strong demand push. Great. Now, do we have a gap in the market? Yes, we do. We have a gap right here. This top wick and this bottom wick are not touching. So let's mark it out right here so you can see it. These two wicks are not touching, and we have a space. So we have a gap in the market. We also have a gap right here and a gap right here. Now you always want to use the first gap. The first gap's always going to be the strongest high probability gap. So now we have a demand push, we have a breaker structure, and we have a gap in the market. Last thing is we want to make sure that we're in our trading session. So we're not going to enter this trade until we're in this gray box. So when price finally goes up up, comes back down, and we tap into this, we can take the trade. So as soon as it taps, we can enter right here. You can put stops below the last line right here, just a little bit below to give us some breathing room, right? Because sometimes price will come and tap the line and then go. And you can see you would have made lots of money that day. 1 to 14. So if you risked $1,000 on this position, you would have made 14 grand just off of that. And the reason why you want to have high risk to reward instead of just risking 1,000 to make 1,000 is because there's always going to be losses. So you want your wins to be so big that when you lose, it doesn't matter, because you're in the next trade, you will make 10 times what you lost. Now, me personally, I like to be a little bit more safe when I take trades because we're trading with real money. I like to have my stop loss a lot lower, and I like to enter the trade after the gap has been filled 100%. So after this gap comes and taps this line right here, I want to be in the trade. So the way I draw my rectangle, right, instead of having it right here where the lines are like that, I like to have mine like this. Now on this example, the stop loss is going to be really big because we have this huge wick right here, but usually it'll be a small candle just like this one. So we would get our position, and as soon as price came and tapped this white line right here, filling the gap 100%, we would enter the trade. Put our stops a little bit below the box, and price flies up and we make a 1 to 6. Now we're making less than this one, but we're being more safe and more cautious, right? Our stop loss is bigger and we're entering as soon as it taps this. So the people that lost, so the people that entered the trade right on the first line, they got stopped out once it hits the second line. But us, we just entered the trade. You can choose whichever way you want to do it. They're both great ways. Just back test and you will know which one works best for you. And we will also go over what is back testing in a second. So this trade hit a 1 to 6. Like I said before, there's always going to be losing days. You need your winners to be much bigger. So now I could lose 6 times back to back and we'll just still be at break even. We haven't lost any money, and that's why you want a high risk to reward. So let's go look over some more examples. Let's look for a sell. Okay, so we have a sell right here. Now this is a 1 candle supply zone, but look how big this candle is. Obviously a bank entered, right? Us retail traders cannot push the market like this. So we get our horizontal ray and we say, did this break structure? Yes, it did. So I'm gonna put a line right here and I want you to look at this. This high is higher than this high. So we know once the previous higher low is broken, we have a break of structure. So when this candle came and closed below, we know we have a break of structure. So we have one thing checked off. Now we ask ourselves, was this a supply push? Yes, we already determined that. So that's the second thing checked off. Now we see if we have a gap in the market. Is this first candle bottom wick touching the top third candle wick? Let's see. Let's put a line. Another line. Okay, we have a gap in the market right here. So when price comes back and fills at 100%, right, which is this first line, once it taps it, we enter the trade and we put our stop loss at the swing high, which is the bottom of the candle right here, right? The start of the supply push is the swing high. So as soon as it tapped in, we enter the trade. Price dropped. We made a 1 of 4. See, now if you would have entered the other way, where you enter on the first line and put your stop loss above, you would have lost. Yeah, you could have made a lot more money if you won, but you lost the trade. So to be more safe, we enter right here. And the strategy is really that simple. You want to have a supplier demand push, you want to have a break of structure, and you want a gap in the market. And make sure you're in your trading session. That's all you need to change your life. That's all you need to become a millionaire. Once I learned this, my whole life changed. So now I'm going to show you some real examples of me trading this week so you can see that this actually worked. Let's get into it. So I just entered this trade on Euro USD. You can see right here on the side, this is where you're going to see my profit and loss at using Henko X. This is the broker that I use. I'd like to have TradingView too to mark it all up because I've been using TradingView for years and I just entered my trade on Henko X. This is a really good platform right here that I've been using. I'm loving the new update and I'm slowly going to transfer all the way to just using this instead of using TradingView at all. But for right now, I'm using TradingView. I'm currently in Thailand. My family's in the hotel room with me, so you know, don't get more real than this. Just trying to make some money. Just bought a $15,000 first class flight back to LA. So I got to make money to pay for that. So let's get it. So I'm trying to get a good push right here. We got to get a 1 and 3. So let's see. So we're currently up $500 right here. So it's looking good. This platform actually looks better than TradingView. We're getting a nice push right there. You see we're at 700. I'm really liking this new update that Henko Trade has. The color scheme, Henko X, just looks good, bros. Everything's flowing good. Everything's working good. It's easy to enter. I'm really liking this platform. You know, you got the time frames right here, simple. You got the drawing tools right here, everything you need. Got your pairs right here. All you gotta do is click these little bars right here to pull up a different chart. Sell, buy, you know what I mean? You got everything right here, your indices, commodities. Everything you need is right here. You got your balance up here, equity. I'll probably block that out though, because y'all don't need to know how much I have in my account. But yeah, it's looking good, bro. I like it. They didn't try to do too much. You know, companies be trying to do too much nowadays, bro, and they just mess up everything. They make it all complicated. So we're currently up 1,200. So this is going to be a small trade. I didn't go crazy on this one like the last trade. I'm already up a lot. I also have this copy trading to other accounts. Henkel Trade also does have copy trading. So if you guys want to, you know, copy someone's trades, you guys can go on there and, you know, find someone who's profitable and copy their trades. So this trade will probably pay for the hotel room. And the next trade that I take on futures will pay for the ticket. So that's just like, you know, you really get a life of freedom when you could just trade and pay for whatever you want. Like whatever you want to do, you just be like, all right, I'm gonna go make this in the markets today. I'm wishing I would have went heavier on this position because it's just flying in TP. All right, so we're getting a great push right now. See, when you got the right supplier demand zone, you're gonna get a lot of momentum off of that zone. So when you guys take trades, you know, mark down how the supply and demand zone looked, what type of push you got off of that zone, you know, and after months and months of writing it down and journaling it, you're going to start saying, okay, these supply and demand zones work way better than these ones, so I'm only going to take these ones. And then you start, you know, slowly sculpting your strategy. It's a nice push right here. It's looking really nice. Only cons about big pushes like this is that the next candle might come and take your stop loss, so if this could get like up here, I might just close it. All right, boom, taking that. I'm good. TP was basically here. We're about 1 pip away. So hotel room was paid for. So that's fire. Look, we about to hit TP too. This is a fire trade. Straight to TP, bro. Straight to TP. Shit is lethal, bro. Every strategy I have is lethal. So for those that still ask if I still trade Forex, there you see it right there. I'm doing this shit, bro. Did it the last video, did it this video, TP would have been here right there. Like, come on, bro, I do this shit, bro.